Sunil, talking about numbers, and weaving it into, I guess, diplomacy as well. Early this morning, we were talking about how Xi Jinping is set to go on a road trip, right? Vietnam, Kuala Lumpur, and then Cambodia, right? And this is in the middle of a trade war, right? When that number just went up overnight to 145%. Do you think he's going like, yeah, okay, right. You guys do whatever you want. Our exports to the U.S. only account for 3% of our GDP, so it's going to hurt. But I'm not too worried. I'm actually being more proactive in talking to friends and neighbors about what we can do to accelerate trade and maybe even lower tariffs.
You're absolutely right, Martin. Look, I think if you just looked at, as you said, Chinese sort of exports as a percent of the GDP, it's around 2-3%. It's the same for a lot of the other markets, including India, and for the emerging market as a whole, that's the number you are looking at. So China, and it's much more worse in terms of the U.S. exports as a percent of GDP for countries like Vietnam and smaller open economies like Malaysia, Thailand, and parts of Korea and Taiwan, right? Yeah. So for those markets, the hit from the trade as a percentage of your own GDP is huge, and so there is more impact there. For China's case, it's smaller, but effectively, I think what's happening is that because you're taking out the 30% of the demand out, so everybody's kind of competing for the rest of the 70% of the market, right? Yeah. And so I think every other player is trying to see where they can get more end markets for their products if they are not going to sell the same products to the US.
It's going to be like trade Hunger Games, sort of, right?
Look, I think it is going to rebalance the trade equations across the globe, but at the margin, what it means is that it would have impact on activity and it would have impact on growth.
So let me ask you, you're overweight China and you prefer A's to H's. We know there's already been this valuation differential, right?
Yes.
So there's an arbitrage opportunity, but you're more keen on A's. This is onshore domestic, right? How much of that is because, as a result of what is going on now with the tariffs, etc., China is, and that's what the latest report seems to suggest, right? They're convening, their version of, I guess, a trade war council, going, okay, guys, what do we do? I think it's probably time to step up stimulus for the domestic economy and to help local companies. Is that why you're more optimistic on A's? In addition to the fact that they're cheaper.
I think the domestic stimulus will help both parts of the market, right? And as I clearly said, we are expecting more forceful policy stimulus from China, and the augmented fiscal deficit will go from 10 to 14%. So that's a meaningful increase in the deficit. But that's going to help both the markets, and that's going to help offset some of the growth weakness. The reason we are more positive on A shares, as you said, is because we are kind of moving, or not exactly moving, but you could see a rotation in the markets from sort of AI-driven rally to a sort of domestic consumption-driven rally, because the stimulus will obviously help the domestic demand and the consumption-related sectors. And if you look at the onshore equity market, the market is kind of more geared towards kind of policy stimulus as opposed to offshore market. We also know that if you look at the foreign ownership of the onshore equities, it's less than 5%, right? So it's relatively more insulated from the risk off we might see in the two pockets. And then you also have the support from domestic buying in terms of quasi-sovereign entities and national buying. So that sort of domestic flow can also help the onshore markets more than the offshore market.